It has now hit the 11:30 mark in the Eastern Time Zone, which means, as promised, we are about to bring in Brett Manning, chart trader. Good morning, Brett.
Jim. Good morning.
So you had some things that you pointed out in your early note, but before we get to that, I really want to pick your brain a little bit about a notion that I realized over the last couple of days. And it's from a trading standpoint, and I think you'd be a good person to ask about this.
Shoot.
So yesterday, you got short the NASDAQ, and you weren't looking for very much. I think you took a 10-point risk. You took a little money off the table. And now, as we look forward into today, had you left something like that on, it would have been a really good trade. Scalp Trader also noted yesterday that he was a little early trying to short the marijuana stocks. I think he was involved in CGC yesterday.
Yep.
You highlighted a rollover in the marijuana stocks today. Now, with all that in a capsule, what we can learn from this is you guys were both probably a little bit early on the particular move. So, with that in context, is it time to start thinking about expanding our risk parameters or expanding our time horizons as we may have a uptick in volatility?
Yes, so I think that there's a process that Scalp Trader and I both use, and we've talked about this before, where we do little testing orders, and we have an idea, and when we start to see more confirmation of it, we get a little bit more aggressive, but you still need to have the setup in place. And there's oftentimes, where the move goes without you, or you need to circle back around and wait for a second part of that move. But you've got a kind of thesis. And yesterday, for me, I can't speak for him, but for me, as far as the NASDAQ was concerned, one thing is the first trading day of any new month, there are oftentimes some strange dynamics that start to play into the tape that are relatively unpredictable, and you need to kind of get a sense of, you build out a context. In August, I think we saw strength in the first couple days of the month that was kind of really at odds with what we had seen toward the end of July. And it was just new monthly flows. Sometimes those decisions are made from a top-down level at big funds, and they've got an idea of what they want to do. Sometimes it has to do with how pension funds need to rebalance things. There's stuff you can't really predict in advance, but you kind of see where the context is headed. And yesterday, I saw an intraday pattern that suggested a low-risk shot to get into a position in the NASDAQ that would either carry through to test the intraday lows or it wouldn't. But the very, very, very short-term pattern and the tape read and the order flow suggested that the timing I had there, I was able to feel extremely confident that I would at least get 10 to 15 points in the money, and that would give me almost like a freebie shot if we were going to continue lower in the afternoon, maybe close on the lows, open today on a gap down, and that we were seeing a turn that was going to define the context for September. So I wanted to put that on, but I wasn't going to fight a situation where, as I said later in the day, where you really have a larger context uptrend that's in place, and you also have a sentiment situation that isn't risky for the market. We are not at a point where there's tons of speculative money just washing around on the long side in the market. None of the stats that I follow suggest that right now. So, it's not something I'm going to leave on and in place when I'm either flat or out of the money in that type of situation, playing against the larger trend. Not when we're coming into a new month like that, for sure. But I did have, as I said, a very, very short-term setup that offered me almost a free shot if the universe that we lived in turned out to be the one where this was a market that was going to close on the lows, that the morning weakness was going to follow through into the afternoon, and that people better get ready for a change in the trading environment as we head into September. Now today, we're starting to look like we're heading for some kind of change in the trading context. Now, maybe this has to do with some of what we're seeing in Washington, D.C., and some, more tension between Washington, D.C. and the mega-cap tech stocks, which has been a theme, I think, that's emerged over the last couple of weeks. And now we've got, obviously, Twitter at Senate, and, we've seen some more tweet storms and things like that. And that may be all it is, or it may be that we're starting to see some context that's going to define September. And September, as I pointed out this morning in my notes, is actually the only month of the year that posts a median loss historically. relative to, for the S&P relative to all other months. September is the only one where, the median outcome is a losing month. So, there may be the ability to feed on itself a little bit here. And the chart that I put up for the S&P also shows that we're coming off of a test of the upside of the trend channel that we've had in place. So it's a reasonable time to expect some consolidation. But as far as the managing the position, I don't think there was any way, given the way that the afternoon resolved, that I would still have been in that position. It would have been a brand new setup this morning, and I thought about it, and I didn't get it on.
All right. I noticed, again, that you were highlighting the movement in the marijuana stocks. Does this mean that you're sniffing around that space?
I mean, I think that it is, obviously where you've got one of those dynamics that's taken shape that, current action has nothing to do with probably where these stocks are going to be in a month or two. You've got really small floats, and you've got a lot of speculative fervor, and anybody who's trying to step in front of that lately has been easy to run over just on momentum, and people are trading that momentum, and it's something like a fever, and when the fever breaks, they're going to fall. And I mean, I think that it's reasonable to look for some shorts there if you can get the shares.
Is it going to be something that you're going to be looking into trading this one? Because just based on
chance,
yeah, okay. Well, that is just my little warning shot to everyone to get ready that Chart Trader may indeed be dabbling in some equities. There was another one you mentioned last week, I believe, that I was surprised that you were looking at. I don't think it was the FANGs, but maybe it was. Do you recall which equities you were looking at?
I mean, I was talking about emerging market stocks to some extent.
I don't believe it was that one. I know.
Miners?
Maybe it was gold miners. It might have been gold miners. It maybe during our call we'll remember. Let's move on. So, I guess in context, are you looking to do anything? You're going to sit tight in the equity markets now? As far as the futures, of course.
What I like to see, obviously, is the uptick in volatility, and that's a process of range expansion. And so, one of the best pieces of advice I've ever gotten or given in trading is when you have an initial first day or two where you may be seeing range expansion, the type of range expansion that may stick around for a few weeks, it's really, really, really a good idea to avoid overtrading initially, because your instinct is going to be to get all excited. You see all the movement, you see the increased volume, but there's a process of acclimation that has to happen, or you can really hurt yourself. And this is one of the ways that I hurt myself when I first started trading years and years, longer ago than I'd like to talk about. But this was something that happened to me several times and helped me really learn this lesson. When you have a market that's been trading at relatively narrow ranges and you get an initial range expansion day or two, you start to see a little bit wider movement. The instinct to trade for reversion to the mean in that kind of movement initially is almost overwhelmingly powerful, because relative to what you've been acclimated to in the market, you start to see a move that seems like such an easy trade back the other direction because it's gone so much further. And that's what range expansion really is when you get to that point and then it goes still further. And it really can cause a lot of big losses because the instinct is so strong to get out of the money on a position, but add to it anyways, because of course it's going to move back the other way because it's gone too far in whatever direction it's moving. And that kind of instinctual bias, once you start to acclimate to the wider ranges, you can really make a ton in that kind of market because other people get caught in the same situation. And when you're able to play in the direction of intraday trend, even though it seems like it's already gone farther than you'd think that it should or could or would, those are the trades that really start to become easy in that type of environment. And once everybody acclimates to it over the next couple of weeks, it becomes just a higher VIX type of market with lots of interesting intraday plays. But you don't want to start off that kind of process with a really bad day on the first or second day of range expansion, because it just handicaps you psychologically, puts you in a hole, and then you end up trading from the standpoint of trying to make back prior losses and taking silly risks. And that whole kind of psychological negative feedback loop can kind of take hold right during the time when the market is starting to offer you easy money again. And so it has kind of this double whammy effect that can take away what should have been a great couple weeks and turn it into something that's really, not only is it a missed opportunity, but it's losses of money and it's psychologically impairing. It's actually a triple whammy. And those sorts of experiences can really determine your long-term success as a trader. Just a few turning that the right direction versus turning that the wrong direction in those types of situations is really, it's really kind of, you're going down two paths into your future, and heading down the path where you've got a sustainable, long-term, profitable future as a professional trader is the direction where you learn to lay off the gas a little bit on the first day or two of range expansion and get into the rhythm of it and wait for the easy money setups and start to play in the direction of intraday trend, even though it feels like the market has gone too far. That kind of process and that kind of mindset, looking for small trades, looking for small wins, hitting a couple singles, getting into a rhythm with it. And if you got a VIX of suddenly 17 to 22 and you're in that kind of mindset, then those wins just start to snowball because you start to feel that you're playing with the house's money, you start to feel more conviction, you start to be in rhythm with the market, and you're doing lots of individual trades, and you're building up toward that rather than starting that kind of period off with an initial triple whammy hit that it just impairs you. And if you imagine 6 months later where you're going to be as a trader with a couple instances like that going right versus going wrong, the difference is just enormous. So I would just say, hey, today we've seen some range expansion. We've seen a little bit more volatility. It's the beginning of a new month. It's a month that oftentimes is accompanied by higher volatility. Let yourself kind of observe a little bit, get into rhythm with the way the market is acting, and look for a couple of singles and buys in the direction of intraday trend just at the outset. And maybe, think of capitalizing more third day, fourth day, fifth day into that sequence rather than first day, second day. So hopefully that makes sense because it's been a really important point for me.
It does make sense, and that's good advice. I think the problem that we've run into is that you don't get the second and third day. We'll see a day like this, and the next day you don't see that type of follow-through. Back when I started trading in the early 2000s, you would see this type of thing, and things would open up for the next couple of months, maybe at least the next couple of weeks. I would love it when I would see the volatility. And back then I didn't really mind getting chopped up on the first day because I knew, things are opening up, I'm going to learn from what happened this day, but I do know that the next couple of weeks are going to be good. The problem is we don't get that. So you will, if you do get chopped up on that first day, then it makes it even that much harder because we haven't seen the continuation of that range expansion. So that's what makes it even tougher.
Yes, but keep in mind we're just getting into September now, and we've been through what are often the slowest trading months of the year over the last 4 or 5 months. So just because we haven't been seeing that doesn't mean that we won't. September and October are often two of the best months as far as intraday trading opportunities. So just, be patient. Let it come to you. You don't have to force it. Make sure you take advantages of the opportunities that are there rather than trying to force it when it's not there. And I think that, we're going more. The market is not a brand new thing now where everything is different. It goes through cycles. It goes through periods of one personality, and it will shift all the way to the other end of the spectrum. That's another point that I often make is when you can think of everything in the market as spectrums, right? One side or the other. And generally speaking, on any dimension, and particularly volatility, we tend to build all the way toward one end of the spectrum, like let's say lower and lower and lower and lower volatility, and then moving back to the other end of the spectrum is not a process of gradually moving back to the other end of the spectrum. It's sort of like there's a wormhole from one end of the spectrum to the other. When you get to maximum narrowness and lackadaisicality and apathy and intraday just boredom, you get as far as you can go on that end of the spectrum, and then suddenly one day you wake up and you're all the way at the other end of the spectrum, like we saw in February, for example. Mm-hmm. You just tend to warp all the way to the other end. And my big point is, anytime we start to see that happen, it's important to not get overly aggressive on that first or second day as volatility starts to widen out, or you can get this, this kind of triple whammy effect. So I wouldn't lose hope in the idea that markets will be interesting to trade on an intraday basis aggressively again before long. I think that probably they will. I don't know what the catalyst is going to be, but we've moved a long ways on that spectrum now, and we're starting to see a little range expansion. Let's see how it plays out.
Also, another thing that I've learned over the course of my trading career is that patience is definitely a big thing, and sometimes we just need a reminder to be patient and not get caught up in that. And I stress that a lot, to use the tone of our trading desk as the tone. You'll see a lot of feedback that we'll get, and we'll see a down day like this, and the feedback will be, how come you guys aren't shorting anything? How come you're not seeing anything?
Yeah, I know.
And it's a tough thing to answer, because we've seen it so many times that it becomes, okay, well, we don't need to do it on this first day. And we know that there's listeners out there who want to make money, who are counting on us to provide some good ideas to help them make money. However, it's just not that simple, right?
Yeah, but it really depends on your bias. Like, if you can definitely take advantage of a day like this if your bias has been coming into it that there was a problem. And that a lot of people trade from the direction of, like, let's say a valuation standpoint, or where you're looking at some kind of fundamental theme, either macro or micro, and you've got an idea that something is out of whack in the market, and you're starting to look for that fade. If that's your mindset and you really have a high conviction mindset that way, then you're probably going to make, considerable money on the first day like this. I've been in that situation, but I'm more of the type of trader that looks for a certain style of setup, and I look for everything to tick the boxes for me to kind of get into a situation where this is something that I've seen a bunch of times. It adds up to a very high probability setup, and I'm going to take it, and I'm going to wait until I see that. And oftentimes when you have a change of direction, it takes context forming periods. You've got to go through resetting the rhythm of the market, resetting the patterns, and establishing a new kind of directional context before the setups become something that tick all those boxes. But there's definitely situations where I have hit big trades on the first day of a change of direction, simply because, I've had reasons. Well, okay, February is another good example. I started shorting the market at the end of January because I had strong reasons to be looking for that. And one of them was certainly that, as I documented, we had the likelihood of an impending implosion in the short VIX trade bubble, at the same time as we had a huge number of sentiment data indicators suggesting that that there was an absolute unsustainability to the rally, and that it was just a matter of time, that it was just, it was running on fumes. And so I had that bias coming in, so when we started to the downside, I was already short. But, this situation, we really don't have that type of context at all. So it's more about watching to see if the market wants to see, work through a September that involves, a little bit more of a nod to some of the macro problems that are going on, and a little bit of a step up in volatility, and people starting to, kind of position for. Sometimes it's just a self-fulfilling prophecy. If you got some larger players in the market that are just starting to position for the possibility of some volatility into midterms or whatever, that can just cause money flows to shift, and the VIX starts to move back up, and you start to get a different pattern context to take advantage of.
Well, I know one guy who snuffed this out a little early. That was Event Trader.
Yeah, he did.
Yeah,
sure,
so
right
kudos to him.
Yeah, it was nice.
I was going to let him jump in and take his congratulatory speech, but I guess he doesn't want to yet.
I'm just listening
there
to the conversation. So, sometimes you're better listening. So if I got anything to add to Brett's, I definitely will. But like our listeners, I'm just hearing what Brett has to say right now. But thanks for the kind words.
Yeah, you're welcome. Anyway, so back to the markets. And one of the things that I was curious about coming in today, I talked to Gavin a little bit about this in the pre-market chit-chat, and that was China was down a lot. Are we now starting to feel some of the pressure about the, I forget exactly what it is, the comment period closing on China later this week? Because it seemed we were ignoring that for a while, but now it's that crunch time. Are we now feeling it?
I don't think that there's been any signals that suggest anything. I don't understand why people would doubt what's going to happen here. Like, it seems pretty clear that both sides are just going to dig their heels in, and China has the resources right now to let this play out, and I don't imagine there's any way that they're going to grant a trophy concession to the White House ahead of the midterms. That seems to me like an absurd plan. They've come this far. There's almost a psychological sunk cost bias. They have a depreciating currency. They have the ability to lever up. They have the ability to hit their economic data points because of the depreciating currency as well as because of the resources that they have. So this stage of the process, even with increasing those tariffs along 200 billion, is not something that's going to immediately cause a failure of the power consolidation structure in Beijing. And that's the only thing that they would worry about right now, because the long-term path for China is unquestionably a better path if they can avoid granting some kind of success, some kind of big party for the White House to say, we came into this with a theory about how to deal with China, and it turns out we were right. And so go ahead and write it down in your history books. The proper way for the United States to manage its trade policy relationship with China is by being a hardliner, by being highly protectionist, by being aggressive with tariffs and all sorts of things like that. China conceding right now would just validate that as a strategy. And it would do so for voters here. It would do so for, congressional members, all sorts of, it would just be a big win for this process. And I think that the last thing China wants to do is grant that victory. So I think they're going to keep weathering this, and I can't imagine that there's any other outcome. And making trade policy with China, there's a lot of people that are suffering from this in the United States. I have an uncle who runs a technology company that makes a device that converts some kind of input into your house into some kind of universal outlet or something. I'm not exactly positive on the details. It's like a special kind of outlet, and he sells a ton of them to like hotel chains because they all convert to it because they can centrally control everything, and it turns everything into Wi-Fi, and there's only one type of outlet that's for everything. Anyways, he gets a lot of his stuff manufactured in China, but because of the tariffs, he now has to take those tariffs back on the imported products coming back to him. And he gets, I think he was making margins of like $40 a unit, and they've been shaved to like $5 a unit because of this. And he's going to go out of business, he's pretty sure, unless this situation resolves itself. And I think there are a lot of people out there in very similar situations right now, and that's the way that China is able to battle back against this, is by that kind of undercurrent dominating how people on a day-to-day household basis perceive this trade war with China, and having that maintain itself in place into the midterms.
Hey,
and
Brett.
Yeah.
I'll let you finish your talk. I did want to follow up with a question for you on China, then when you get a chance. So sorry if I jumped in too early.
Yeah, no problem. But I mean, I think that Chinese equities are going to be something they've made their peace with as far as a whipping post right now, because no market is going to like to hear that things are going to be fine in the long run, but we're going to be willing to take some short-term pain. Like, there's no way that's easier to get money flows to leave something. So eventually that's going to be a great value opportunity. Eventually the market's going to start to look around the next corner and put a bottom in it. But I don't think that there's any way that this is going to resolve itself in the next few days by China conceding on important points.
Right, and I guess that leads me to the question I was going to ask you, Brett, that you kind of hit on it a little bit, because I'm of the impression that this $200 billion in tariffs isn't necessarily priced into the markets, but perhaps I'm wrong on that, and that it's just really kind of being priced in on a one-sided basis, meaning the emerging markets are getting hit with this while the U.S. is being viewed as the potential winner, probably because we haven't really seen any evidence just yet of these tariffs really slowing down the U.S. economy. Of course, the fiscal stimulus could help offset that. What are some things that you could see in the markets in terms of a reaction to a headline about $200 billion in tariffs that would suggest to you that the market could be potentially misplaced in its idea that the U.S. is going to be the clear winner here and emerging markets are just going to continue to get hit?
So you're suggesting, first off, there seems like there's two questions in there. One is if we look at any market that's sensitive to this process, have the markets accepted the idea that the $200 billion is actually going to happen?
Correct. That would be the first part.
And then, right, and then if not, if markets haven't successfully discounted that idea, then what reactions would start to show they're beginning to discount it? Is that about it?
Yeah, that pretty much sums it up. And I guess,
although the idea of the U.S. being the winner is another point, right?
Right, right. I mean, certainly the action over the last few months, I mean, the U.S. has easily been outpacing emerging markets. I mean, the dollar strength, I think, kind of highlights that, which, is an area where I'm certainly looking at. But I'm curious as to your thoughts in terms of placement for that $200 billion in tariffs, and, basically whether or not you see any potential red flags that would suggest to you that people might be a little bit either too much off sides, as I know is common.
So, yeah, I think I understand, and I think I have an answer. So I would think that in the circumstance where the market hasn't fully adjusted to the idea of 200 billion going across, and further that when and if that does, that might actually be something that calls into question the idea of whether or not that's a good thing for the United States.
Correct.
Yes, and so I would think definitely a rally in 10-year Treasury bonds would be the way to go there. You got massive short 10-year Treasury bonds, all-time record. The presumption that U.S. interest rates are heading higher, if this turns out to be something that goes through and the market starts to see it as a possible obstacle for the United States in terms of its economic performance over the following couple quarters, then I would think that you would start to see 10-year interest rates come down, given the positioning there.
Okay, that's interesting, regardless of the Fed.
Yeah, I don't think the Fed controls the long end of the curve at all. In fact, I think that this would lead to a quicker move toward possibly, inverting the yield curve would be another signal of that, right? The Fed keeps hiking, and yet this is a possible obstacle for the U.S. economy is exactly the sort of thing that I would think would help the yield curve possibly give its first inversion of this cycle.
So a knockoff being potential weakness in financials?
I guess so, yeah. That makes sense.
All right, no, that's good.
All right, so you had talked a little bit in your morning note, Brett, about some opportunities that may occur when the dust settles. You didn't give a lot of context to that, so why don't we walk through what you are seeing as potential plays coming out of some of this dust settling? Okay,
so let's put that context, that comment in context, which is the idea that the emerging market space has been the area of the equities market now that has generally suffered, China included, but that there's been a kind of overall, theme going on there. The comment that I made this morning was essentially that there's this pattern of activity, which I've described before, but it remains completely in place. And it's kind of like this idea of a tragedy of the commons, where there is tragedy of the commons refers to a game theory dynamic where everybody in a system has a logical basis to make a particular decision, and that would be in their best interest individually. However, if everybody makes that same decision at the same time, then it's in everybody's worst interest. So, like, for instance, in a recession, if everybody saves more money, you end up prolonging and deepening the recession because it takes consumer spending to get us out of the recession. So, but from any individual's case, since they're at greater risk of losing their job, it makes sense for them to save money. However, if everybody does it, it increases the likelihood that they'll lose their job. So that's a tragedy of the commons dynamic. And the emerging market space suffers from a tragedy of the commons dynamic in finance terms, in terms of money flows. Everybody knows that if everybody starts pulling out of the emerging markets in investments in equity and debt and currency and everything, then it's going to crash the complex. That's bad for everybody, and it actually causes problems in the emerging market space that wouldn't otherwise be there. But so for any individual, it's prudent if they see that kind of dynamic starting to develop that they tighten up their portfolio exposure to emerging markets in general. So for instance, even though India has no problems here, really in and of its own right, it's Turkey and Argentina and China that have their own individual issues. This problem isn't a problem of a forest, it's a problem of a few individual trees. But people start pulling their money out of assets for the forest as a whole because they know that everybody else will soon. And it becomes a kind of self-reinforcing feedback loop, and it causes problems in emerging market economies that don't inherently necessarily have a problem right now. And so my comment today was, as that starts to hit emerging markets that have a much better longer-term fundamental picture and not as many problems, you're probably going to see, from a value-based perspective, a lot of opportunities open up. The EEM is heading for, it would look like new lows. And we're starting to see this kind of rolling phenomenon take shape that always seems to at these points, where people just start to limit their exposure to emerging markets in general. But that's the kind of dynamic in today's world where most likely you're going to see some perfectly healthy babies get thrown out with the bathwater, and you just need to kind of look around for the perfectly healthy babies in the aftermath. I don't know what they're going to be right now, but just some of the more fundamentally strong emerging market stories, like in India. If you start to see, mass selling there, and possibly with index instruments and big hedges coming into on the short side into something like the EEM or the EMB, which is an emerging market debt fund, these are probably going to lead to some individual emerging market story opportunities around the next corner. That's all that comment was really about.
Okay, got it. Now, I know India was one of the markets that, talking about being a little early, is Event Trader. I think he jumped in on a India ETF, didn't you, Gav?
Yeah, INDA. So I just think that's one of the top plays over the next 10 years, especially as a potential fallout winner. If U.S. and China are battling back and forth, U.S. is going to look for a counterbalance of power over there in that region, and I think India makes for a logical counterbalance there. And obviously, there's similarities in the geographic makeup and demographics in terms of just pure body count and stuff. So I just think India is going to be one of the fastest growing countries over the next 10 years. So that's why I got involved with that one.
And that's a perfect example. So if we see a big selling pressure in India just as an artifact of mass exodus from emerging market exposure as kind of a tail on the downtrend that we've seen in EEM over the last few months, we see that accelerate. We see people just tossing everything off the bus. Then India is probably a good one to look at to pick up.
All right, so since I have you on the line, why don't we get an update on where you stand on that gold trade that we had on? Let's see. Looking at the chart, I'm going to pull up the GLD chart just because it's easier for me to get that going before it takes me a minute to pull up the futures charts. As far as what you've seen so far, has anything scared you out, or you just staying pat? Okay, so no change really in the commitment of traders or anything that you've seen?
No, I mean, it reinforces the same situation.
Okay.
I think that there's basically no speculative money sitting in it right now, and that opens up the opportunity that if people are wrong, that the reaction back the other way could be dramatic. And one of those points that kind of flows in that direction, and I don't want to overhype this idea because Bullard is not a voting member and he has been super dovish, but I did think it was interesting this morning. He came out and basically made the first kind of a little inkling of a statement about that he expects the Fed in the near term to start to take a look at the possibility of reconsidering its quantitative tightening program. And if you look at the Fed funds futures, if you look out the next year or so, it would take just a very, very small shift from here to put us into a situation where markets are discounting the idea that December is maybe the last hike of the cycle. There's no hike coming in March. There is one hike coming in June plus September, rather than a situation we had not too long ago where we saw hikes coming in June, where we saw hikes coming in March, June, and September. Now almost all three of those hikes have gone away in terms of expectations, while we have clearly still got 70% plus expectation of a hike in December. So that's kind of the market starting to say, hey, way around the next corner, over 3 quarters to 4 quarters from now, we could start to see, some of this expected growth for the United States economy really starting to peel off. And we may be starting to get to the point where we've got an inverted yield curve, and we've got no expected hikes on the horizon, and the Fed's starting to talk about, no longer tightening its balance sheet. And all of those things, if we are starting to get to that sort of point in the cycle, then, it's easy to make an argument that this is when you would see an inflection in gold. This is kind of that point. And with sentiment where it is, that still all completely adds up to me. And the way the dollar is acting now, I think that it is underperforming in terms of its relative expectations, in terms of policy with other major economies, as well as, data like the ISM number we just got. really not seeing a strong dollar. We had that breakout failed. We've moved back into the range, and we're just kind of sitting there. The euro is higher again today. It is just flirting with moving back above its 50-day moving average. It's well back in the range that it was in June and July. So we're just kind of sitting there now, not really seeing much of a dollar rally, despite the increase in sentiment around the dollar, and despite seeing a near-term context that one would think would support a breakout and continuing trend higher in the dollar. So that could be the dollar starting to look around that next corner, and that could also put gold kind of in that perfect sweet spot.
How often have you seen a dollar rally associated with a rally in gold as well? They don't always have to move opposite.
They don't. You're exactly right. But usually, what I find is when you see the dollar and gold rallying together, something is very, very wrong in the world. And that, just as a blanket statement, that typically tends to be when we are kind of dealing with some kind of crisis. I call them the four horsemen of the apocalypse. When you see 30-year bonds, the VIX, the dollar, and gold all rallying together, usually, that's a problem. So I don't expect that right now, but I could see the dollar kind of weakening relative to where you'd think it would be, and gold kind of putting in a bottom here that maybe takes a month or two to gradually form before we start to see some kind of, hey, maybe the voting members start to kind of toss around the idea of, we don't need to do quantitative tightening anymore. It kind of hits the more mainstream. And the way I put it in my comment a few minutes ago is Bullard's comment this morning, I think, is kind of like seeing some leaves turn on a tree. In the autumn, it doesn't mean snow is coming the next day, but it's a sign, when it starts to be kind of up for discussion at this point in the cycle. We're seeing where we see the Fed Fund futures course kind of tipping toward maybe no hikes next year. And we start to see a Fed member talk about maybe no longer quantitative tightening, then, that's kind of, the leaves are turning a little bit. Doesn't mean the cycle's over, but,
Well, I got a fifth horseman for you.
What's that?
The yen.
Oh, yeah, absolutely.
Could you imagine?
Right. The yen. Yeah.
All of those things going up at the same time.
Well, usually, it's 4 out of the 5, let's say. Maybe it's not gold, maybe it's not bonds. Who knows? One of them kind of subs in and out. We'll call it the 5 horsemen, though.
All right. Well, we're reinventing history here with the fifth horseman.
Well, and obviously, to argue back, obviously, if you're seeing the yen, then the yen's outperforming the dollar. So the dollar may be outperforming everything else, but let's call it the yen. You're right. We'll call it the yen. But the dollar is still probably strong in that type of context.
All right. We've covered a lot of bases on this call. Is there anything that we might have left out that you really want to bring to the listeners' attention?
Yeah, one thing that and Gavin can jump into this conversation if he's still around. We got a question. We got a question from somebody just talking about seeing Paul Ryan start to put back on the table the idea of a new tax cut right now and just what the implications are. And my comment, Gavin, add whatever you want, but it seems to me like we're just kind of putting out there something in front of midterms. I would expect that, we would see this as Gavin put it, there's no chance of that passing. But,
they need 60 votes according to Carmine to get it passed, and we know how partisan the Senate is, and there's zero chance of that happening.
Right. So, but I think the ideal plan then for the GOP would be to put something up that gets delayed, to get it on the table, to get it front page, and then to kind of try to maneuver for a situation where some kind of adjustment can be made and they can put it back on the table for a revote in January. And we come into the midterms with this idea that you can put out as a campaign idea for the midterms. If you're voting for a Democrat, you're voting against a tax cut. Because we'll get that tax cut if you keep the Congress just as it is right now. That kind of idea, whether or not it's true, is another point. But just to kind of put that in people's mind, tap into that populist greed of saying, hey, you will get more money in your pocket if you don't vote us out. And I think putting that kind of decision matrix in front of people and recasting the midterm vote as about that rather than about any of the other larger issues.
I'd agree 100% on that take. It's simply trying to get it out in front of the midterms so they can point and be like, look, we want to give you money, they don't vote for us. And I do think it's as simple as that. And again, I don't know, the comments came around right at the time of this bounce. We're also hitting some support area in that 2880 area. So perhaps that certainly helps play in. But if we are bouncing because of those tax cut headlines, I wouldn't look for that to stick around and be much of a supporting headline.
All right.
All right. Well, I just assume step aside when it comes to political discussion. I would I would kill brain cells for the listeners if I had any input, because I'm just so out of the loop when it comes to it.
Really, our focus always is on that. Brett, correct me if I'm wrong, is more or less the market reaction than the actual content of the message per se, and then whether or not we feel like it was just some of the short, fast money that reacted to it, or if there's a meaningful sway in the narrative in the markets. And if we continue to see headlines as we slide lower pressed about further tax cuts, I think that people should be careful and discount them, because ahead of any midterms, I just view it as a talking point rather than anything that's likely to happen.
Yeah, absolutely.
All right. Well, I guess with that said, we pretty much covered everything that we had planned on. So if that is it, Brett, unless you have any other trades up your sleeve, I think we'll end it there.
You got it.
All right,
Thanks.
my man. Well, thank you so much. And Gavin, thanks for joining in.
No problem at all, Jim.
All right.
Hey, Brett, thanks for the comments. Good stuff as per usual.
You got it, Gav. Thanks.